Welcome to The Explainer. Today, we're tackling a term you've probably heard thrown around, maybe with a hint of danger attached to it: junk bonds. We're going to break down what they are, where they came from, and why they're one of the most powerful and, yeah, controversial tools in all of finance.
So let's just dive right in. The story of junk bonds, it's this wild tale of brilliant insights, cutthroat corporate warfare, and financial crises that have totally shaped our modern economy. It's a world where taking a massive risk on something that's literally labeled junk can build an empire or, bring it all crashing down.
Okay, but before we get to all that high-stakes drama, we've got to cover the basics. First things first, what even is a bond? Well, at its heart, it's a really simple concept. Think of it as the ultimate IOU. So it's pretty simple. When you buy a bond from, say, a company or a government, you're basically lending them money. And in return for that loan, they're promising to pay you back the full amount on a certain date. Plus, along the way, they'll usually pay you interest. This is actually how huge projects get funded. We're talking everything from new factories to public highways. Now, in this whole bond world, you've got two main players. The group that issues the bond to get the cash, that's the borrower, or the obligor. And the investor who buys that bond, that's you, maybe, is the lender, the obligee. So if you're the investor, you're the one holding that promise of getting paid back. And, some of the safest IOUs you can possibly get are from really stable governments. Take US Treasury bills, for example. They're considered pretty much free from credit risk. And why is that? Well, it's almost impossible to imagine the US government not paying back its debts, right? Okay, but what happens when the borrower isn't a super stable government? What if it's a brand new company or a business in a really volatile industry? All of a sudden, that promise to pay you back, well, it's not quite so certain anymore. And this, right here, is where the concept of risk comes in. This is where the world of bonds starts to get really interesting. So, to help investors figure all this out, you've got these independent credit rating agencies. Think of them like financial detectives. Big names like S&P and Moody's, their whole job is to investigate the financial health of whoever is issuing the bond. Then they slap a grade on it. And that grade, it's basically their professional opinion on how likely it is that you'll actually get your money back. And this rating system is basically a ladder. It shows the whole spectrum, right? It goes from the absolute top tier, super safe, AAA rating, all the way down to a D, which means, oops, that borrower is already in default. But the single most important thing to see on this ladder is this crucial dividing line, right there in the middle. And this is the big divide. Anything with a rating of BBB minus or higher is considered investment grade, generally seen as safe, pretty reliable investments. But anything rated BB plus or lower, that falls into a totally different bucket, speculative grade. And that, my friends, is what everyone calls a junk bond. So the big question is, how did these risky, quote-unquote, junk-rated bonds become such a massive force in the world of finance? Well, for that story, we've got to hop in the time machine and go back to the 1980s. It all started when one investment banker had a truly revolutionary idea. This guy, Michael Milken, he noticed something that pretty much everyone else was missing. He started studying these things called fallen angels. Now, these were bonds from companies that used to be stable but then got downgraded to junk status. So while the rest of the market was treating these bonds like trash, Milken did the math. He figured out that the super high interest they paid more than made up for the increased risk that some of them might default. He saw a huge, completely undervalued opportunity just sitting there. And Milken didn't just trade these bonds. He basically created a whole new market for them. He started underrating new bonds that were rated junk right from day one. And the result? It was absolutely explosive. Get this, a market that was virtually non-existent at the start of the decade ballooned to over $180 billion by the end of it. Just incredible. So this powerful new financial tool, it quickly developed this kind of split personality. It had two faces. On one hand, it was this revolutionary way to fuel growth and innovation. But on the other, it became a pretty devastating weapon in the world of corporate warfare. All right, let's start with the good side of the coin. For tons of companies that were maybe high risk but really promising, junk bonds were an absolute lifeline. They provided the cash they needed for expansion and innovation, especially when traditional banks wouldn't even look at them. I mean, entire industries like the telecom boom in the 80s were practically built on this kind of high-yield financing. But there was a much darker side to all this. Junk bonds also became the weapon of choice for a new breed of investor,
the corporate raider. See, they could use these bonds to raise insane amounts of money to launch hostile takeovers of perfectly good companies. In these so-called leveraged buyouts, the raiders would literally use the target company's own assets as collateral to buy it. Then, they'd load it up with all that new debt, strip it for parts to sell off, and just walk away with a huge profit, often leaving just a hollowed-out shell of a company behind. Now, you might think this is all just a story from the 80s, but it's not. The core idea, this concept of packaging up high-risk debt to offer super high returns, it didn't go away. It just evolved. And its modern descendant ended up playing a starring role in the biggest financial meltdown in generations.
Okay, so fast forward to the 2000s, and Wall Street takes this concept to a completely new level. They start bundling thousands of risky loans, we're talking especially subprime mortgages, into these super complex new securities. They're called collateralized debt obligations, or CDOs. Now, by slicing these bundles up into different pieces, what they call tranches, they could structure it so the top layers got paid first, which made them seem safe. And the rating agencies often gave these top pieces investment-grade ratings, even though the whole package was just stuffed with junk.
And, well, you know what happened next. When the housing market turned, those subprime mortgages started to default in massive ways. All of a sudden, those supposedly safe CDOs were revealed to be full of what everyone started calling toxic debt. The panic that followed was it was unbelievable. It vaporized trillions of dollars and led to the collapse of absolute giants like Lehman Brothers, kicking off the 2008 global financial crisis.
I mean, the crisis was so deep, so profound, that the entire global financial system was teetering on the brink of collapse. The US government had no choice but to step in with these huge bailouts. We're talking about things like a $500 billion program that was designed just to buy these toxic assets off the bank's books to stop a complete and total meltdown.
So at the end of the day, what's the crucial point here? It's the junk bonds, and all the things that grew out of them, are a classic double-edged sword. They really represent one of the most fundamental trade-offs in our entire economy, the relationship between risk and reward. On the one hand, they can fund the next great innovator. But on the other, they can fuel a speculative bubble that threatens to bring the whole system down.
And that really brings us to the essential question that this whole story forces us to ask, right? Is this kind of high-risk finance a necessary engine for growth? Or is it just an inherently unstable system, one that's doomed to create one crisis after another? That is the debate that's still raging at the very heart of modern finance. Thanks for watching.